You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, HECM's Appreciating Line of Credit, part 5 in our series on the HECM Retirement Strategies with mortgage broker John Mangels. All here on Let's Get Down to Business. Welcome to the 5th segment, John.
Thanks, Steve.
John, we're going to talk about something here that's going to, you thought segment 4 was bizarre, buying a home for half the value. Get ready for this.
Yeah.
I want to walk through the yin and the yang of HECM Appreciating Line of Credit versus the traditional HELOC line of credit and how it works.
Okay.
So walk me through the traditional one first. Let's do HELOC. Everybody is going to probably know that, appreciate it, have some idea what it means. Give me the acronym and then walk me through it.
Right. So the acronym is HELOC, Home Equity Line of Credit. It's pretty much as it sounds. So if you have a $50,000 line of credit, it's like a credit card. You can draw it down. You can pay it back. It's a revolving line of credit. Pretty simple. What we found out and what a lot of consumers found out, what they didn't know, was that the bank can cancel that line of credit at any time. They can.
Why would they cancel it at any time,
Well,
John? What would be a reason?
The value of your home dropped.
Oh.
Yeah. So that was,
So a HELOC equity line is tied to the market value then. That's what I just heard you say.
So that's correct, yeah.
Okay.
So
So do I have to pay any interest as I'm going along this road?
yes, of course. So with a HELOC, you usually have a revolving period where you can access your available credit. Usually it's 10 years. After 10 years of making interest-only payments, whatever the balance is, they then term out either 10 years or 20 years. So you are making interest payments during the revolving time, and then at some point it becomes a term loan that you pay back principal and interest.
Yeah, but you just said the scary thing for the consumer. If your market value dropped, it's going because the equity line is tied to it, you could have your contract called.
Absolutely.
All right, and it's not FHA.
It's not FHA, and it's not on a case-by-case basis. So what we saw in Maricopa County was prices went down. They didn't look at it. If you had a HELOC with 50% equity, they didn't care. They still just wiped it out.
They still called it.
Yeah.
Unbelievable. Now, that's what we've been living with. We've had it all our lives. Now, for seniors, right? For seniors, a little different story at age 62 under the Home Equity Conversion Mortgage Program.
The contrast is, one, it can never be canceled. So once you get it, you've always got it. The government can't shut it down.
Even if your home value was
Even if
dropped?
your home value's dropped,
Wow.
and that's because of the FHA insurance. This product is for as long as you own that home. So once you've got it, it cannot be called, it cannot be canceled, the line can't be frozen. And so from that perspective, it offers a lot more safety and ongoing ability to use as a planning tool.
Okay, so no, I just want to make sure I got this. No interest due.
Yeah, of course, there's no interest payment.
No interest payment. No 10-year contract.
Correct.
I got an FHA.
Insured loan.
Insured loan. My house value could go down. I can't get called.
Correct. Yeah.
Why would a senior not look at this? I mean, from a retirement point of view. Now, here's the other astounding, and only the government can come up with this. I can't make this stuff up. I said earlier in our first segment, right now, if you were to wait from age 66, full retirement age, to age 70, maximum Social Security age, you would be making 8% simple just to wait. That's how much more you'd make. If you're full retirement age and you have $1,000 as your full retirement benefit, it will be $1,320 at age 70. So that's a big bump up. I don't know where the government's getting 8% simple, which is probably somewhere around, I'm going to say 5.25, if I did the math right in my head here, about 535 compounded. I don't know anybody guaranteed giving that. Here I'm at 6.1% appreciating line that compounds annually if I don't use the loan.
That's correct.
Did I get this right?
Yeah, it's a major benefit for HECM.
So, this line of credit, despite the correlated market value, at 6%, if I let that roll for 10 years, we're talking some money at 6.1. 6%, I think it's 6% somewhere around there today.
Yeah.
How can that be? It just sounds incredible.
Well, there's already talk of, them trying to eliminate this. It doesn't make any sense, right? And so people are saying, what's going on here?
But this is true. This
is absolutely true. You do get this, it's a appreciating line of credit.
Okay. I had a gal that went to one of the seminars, and she said, Steve, I love the home I have. I'm great. I have plenty of income coming in. And I said, well, do you have long-term care insurance? She says, no, I don't. And I said, well, why not? She goes, well, because I can't pass the physical for a traditional standalone long-term care contract. I said, have you looked at the hybrid products with long-term care on an annuity or long-term care on a life contract? She goes, yes, but she didn't think the mathematics worked, which anytime a client tells me that, somebody told her that, and it could be true. I mean, sometimes the math does not work, so it's not suitable. Okay, so I said, you know, you could open up a HECM equity line of credit. You may never use it. You may never need it. But sometime in the future, you're going to need some kind of assisted living, at least at home. And you strike me as a person that doesn't want to go to nursing home. She goes, no way. So I said, well, you know what? You could, at that time, when you're saying I'm going to need a little help, you could go to your HECM equity line of credit and go ahead and set your home up for geriatric living, the walk-in tub, taking your stairs and making them ramps, because it's the morbidity accidents or events that happen in our retirement that actually shorten our mortality on many of these women, especially because they outlive men 87% of the time. So I'm looking at this. I could go ahead and use this for home improvement. I could use this for assisted home living. I could even leave it alone as a financial backstop and a reserve account in case everything else goes to hell in a handbasket and I'm now dirt. All I got is Social Security and I got this HECM line. If that's all I had, I could tap it.
Absolutely.
Unbelievable. I don't know why. I guess I say this, even if I didn't want to do HECM for income, even if I didn't want to do HECM to buy a home, I'd be doing this all day long just because I don't have to pay it back.
It's also a hedge against your house value going down because they can't close it if housing prices crash again. You still got this line of credit that can be tapped into.
I'm just trying to think of a 65-year-old female who's so healthy and super, preferred health that she lives to 95, 30 years from now. That line is going to be bigger than her home.
Yeah.
I mean, I just want you to think about that line of credit. It could be huge.
Yeah.
And talk about it, if you don't use that line of credit, I'd be wanting to use it just at the last second.
Yeah,
just before I die.
We have, some people say, write out a check and stick it in a drawer.
Exactly. Because
I
just want to have that. These are huge opportunities for seniors to change. And these are, if these were small modifications, I wouldn't care and I wouldn't bring you on the show to talk about it, John, honestly. Yeah. The three things we talk about: income, tax-free income, buying a home, having an appreciating line of credit. All these things are major impact statements on retirement planning. And I use HECM as an advisor on my first phase. I want to get that mortgage off the table. I want to try to reduce my debt before I get to that point. And I want to be able to use Social Security and maybe an annuity to guarantee my income on my essential and discretionary spending. I want to get that done so I can do the other things I want to do. Retirement can be fixed. And I think this is probably the biggest godsend I've ever seen. Now, it's not like this is brand new stuff, but the only thing I've heard the last 10 years from HECM and their purveyors are just the income. I didn't hear about the home equity. I didn't hear about buying a home. So even though it's been on there forever, we're just now discovering this as planners. Right. Now, when you were a planner and you would have seen this, could this change the way you approach retirement?
Oh, absolutely. And I think, again, it's that fourth leg of a retirement strategy that can be used to offset a down year in your portfolio. Well, then you can draw off your HECMs. I mean, there's tons of strategies here that can be used.
I love the guy, when I explain the HECM strategy, he says, okay, Steve, I'm going to send money. If you're right, I'm going to send money on I have RMDs to pay, required minimum distributions. Under the QLAC law, qualified longevity annuity contracts, I can send 25%, not to exceed 125, I can send 25% of my qualified plan into the future all the way to 85. So if mom and dad, that's $250,000, I don't have to pay RMDs on until way late in the game. But I still need the income from it. I don't want to pay the tax, but I need the income. This could be the way to play.
Yep.
If I wanted to say, I want to take my Social Security right now because I need it at 62, but I could delay it because I could use this line of credit.
Yeah.
I mean, this is the power to actually maximize and optimize and leverage your retirement, to me.
Yeah. Don't forget, we're also, for a lot of people, we're wiping out their mortgage payment, which is usually their number one bill that they're paying each month.
Well, let's go down there and we'll close the show out with that. At the very least of HECM, we're going to take care of your mortgage. Maybe you won't get income. Maybe you can't buy a new house. Maybe you won't get a appreciating line of credit.
Right.
But we just did away with your mortgage. How powerful is that?
I mean, we're seeing it more and more. We're working with people that are in their late 70s, early 80s that are still working. They've got, this part-time job. And they've still got a mortgage. And we're like, hey, what about this option?
When you bring that to them, what is that like to see their faces?
Well, I can tell you we've had 3 people last month that we closed on the HECM, and they all have come back with smiles on their face, and you don't know the amount of
relief
knowing if I passed on and my wife now is in a house the rest of her life without a payment. I mean, it's just, yeah, it's pretty incredible.
It is. Well, listen, I want to thank you, John, for sharing the series on the HECM retirement strategies. And keep in mind, before moving forward with any ideas on our show, always check with your tax consultant, legal counsel, and compliance officer. And don't forget, you can subscribe to my consumer show, Steve Savant's Money, the Name of the Game. Daily content you can post on your website, social media accounts, database distribution. I'm Steve Savant. Thanks for watching.